So one of the things I really wanted to stress today as we begin is that the UC Energy Institute began in 1979. 1979 was obviously one of the first energy challenges. And it's interesting today, if you sort of read the newspapers over the last 4 years, you would imagine lots of people have reinvented the energy problem. But it's nice to have a speaker today who goes back to the roots of energy at Berkeley. And I always enjoy having Severin here. I specifically invited him to come and speak when we met at a Christmas party, and I realized some of the new work he'd been doing in PVs was really important to the overall energy mission. And so I can't help but just want to ask you to give a warm round of applause to Severin, because I know he's going to give a great talk, and it's always great to see him at the podium. So here we are.
Thank you, Paul. Is this on and working? Good. Okay. So thank you all for coming. I have a feeling this talk is going to generate a lot of questions. I'm going to try to move through it fairly quickly and then try to leave enough time to answer some of the many questions that frequently come up about this. This was an attempt to get at some of the discussion that goes on about the cost of solar PV by the people in the industry. When it's pointed out that it's expensive, the response is often, well, that may be the case, but it has particular value of certain types. In particular, the two things that have often been raised is the timing advantages, the fact that solar PV produces more at peak times of the day, which is exactly when it is also most valuable, and the locational advantage, the fact that solar PV, if it is put on the end user's location and most of the power is actually consumed there, reduces line losses because the power doesn't have to be shipped over lines, and can reduce the need for infrastructure because you need less transmission infrastructure because you're shipping less power. And those statements were often made, but when I had pushed people for some sort of accounting for how big those effects are, they didn't really seem to exist. In fact, they seem to respond with anecdotes, and including a lot of responses to this paper have been anecdotes, including the standard one of comparing the cost of solar PV to the cost of a peaker plant for producing electricity if the peaker plant doesn't run very often. And that would be a fine comparison if that was what solar PV power was always replacing, but it's not. And this is an attempt to get more seriously at doing those calculations to try to figure out how much adjustment there really is for these additional factors. After doing that, I then feed those into a pretty straightforward cost-benefit analysis of solar PV to figure out how expensive it is and how you can compare that to both fossil fuel generation and other forms of renewables. There isn't much new in that part other than most of the analyses of solar PV don't seem to get or agree with the concept of net present value. That is, that things in the future are worth less, have to be discounted back to the present. And I try to actually use that concept seriously. This is an illustration of the underlying timing issue. The two dashed lines are solar PV production profiles. The solid line is the real-time price of electricity in July of, I forget which year now, but it doesn't really matter. The basic point is that solar PV produces more at the times when the prices are higher, and in doing so produces, in a sense, more valuable than average electricity. Question is, how valuable is that? There are a bunch of other issues that I'm not going to deal with up front. I will come back to some of them. What are the real costs of installation and upkeep? The fact that solar PV panels don't actually maintain their original production levels. It declines over time. There's some grid stability issues and intermittency issues, which I think are actually pretty minor with solar PV as a distributed resource. And then, of course, there are the giant externality geopolitical issues, which I will come back and chat about briefly at the end. So the first exercise here is to simply value solar PV power correctly, taking into account the time variation. And the approach here is very simple, which is to take a profile of PV production and match it with some series of the prices, the value of the electricity it produces. And there are a bunch of different possibilities for profiles one can use, and there are a bunch of different possibilities for prices one can use. And I'm going to sort of use a lot of variations to try to get some idea. The point is to put them together to actually get an overall valuation of the electricity that solar PV produces. And in the process to also correct for this a couple of locational issues. One is the fact that producing solar PV on site reduces the electricity that is dissipated as heat in the process of transmitting it. And the other, which I'll sort of talk about separately because the data don't really allow me to integrate this, is the advantage of putting solar PV in transmission-constrained areas in order to reduce the investment that's needed for transmission. I'm going to come back to that. This analysis will include this correction for line losses, and doing that I'll then calculate the premium value of PV because of its timing. The timing both is the direct issue that it produces more at peak times and therefore replaces more expensive electricity, and the secondary issue that line losses are actually greater at peak times because the losses of electricity transmission actually increase roughly with the square of the load on the system. So I do an adjustment for that. Then there's a statistical issue which I probably won't spend much time on to try to correct for the fact that the data aren't a perfect match between the production and the prices. I use simulation. I could use simulation data for the PV or real production data. Unfortunately, there isn't a good data set of a lot of different sites where PV has been installed, so I end up using simulation data. I have since gotten some actual production data, which pretty much verify what I've done with the simulation data. If anything, the simulation data are probably a little too optimistic. The best simulation source that's supposed to be out there is Transys, which is what I use. The advantage of this, unlike the calculators that are on the web, is that it actually matches PV production, or it simulates PV production not just using the longitude of the Earth, where it's located on the Earth, but also incorporating stochastic weather patterns. So it actually will take into account that some places are more overcast or have more rain, etc. So there's essentially a year of stochastic weather data that essentially matches the average weather pattern that they match with the solar PV location to produce a year of simulated solar PV production. And that's what I use. There's only 1 year of these data, and essentially I just repeat it over and over again for 4 years to match it with the pricing data. The reason I do this is in order to get a longer sample of variation in electricity prices. So there are two approaches also to the price data. One is to use actual price data, and the other is to use simulated price data, and I do both of these. The advantage of the actual price data is that they're actual price data. The disadvantage is also that they're actual price data, and in fact the data I have are from 2000 to 2003, which you might recall was an exciting time in electricity markets, the first couple of years. The second couple of years was an extraordinarily boring time. In fact, there was massive overcapacity in the state and prices were very low. The problem is, though, more generally, that any time period you pick is not going to be the long-run equilibrium time period you should use. And therefore, any time period is going to be idiosyncratic. If you get a long enough period, it will probably equilibrate, though certainly 10 years doesn't seem to be enough in California since we're still having discussions over whether the market is in excess or insufficient capacity. So the other thing I also do is use some simulated long-run electricity price data, which I developed in another paper, that are designed to actually create prices that will, in the long run, cover the full fuel and capacity costs of the production of electricity. So these are prices that essentially are wholesale market prices that vary with demand in the market and that peak at high demand times. In fact, they peak at very, very high prices. And those very high peak prices are what allows the PV, or what allows the fossil fuel generation to recover its capacity costs. At other times, at off-peak times, the prices essentially go to the marginal cost of the marginal generator. And in doing so, at least the marginal generator isn't making much money at all. But overall, they earn enough money to cover their costs. There are large price spikes in a few hours. One would think that's advantageous to solar PV, and I'll talk about that. It sort of is. It's not particularly advantageous because it turns out solar PV doesn't super peak the way prices do. That is, once the weather gets pretty nice, solar PV produces a lot. When the weather gets a whole lot nicer or hotter, solar PV, if anything, actually produces less. And so as a result, this isn't that advantageous to have extremely high peak prices. I use 5 different scenarios. The actual California wholesale prices during this period. I do a second adjustment for the fact that there are price caps at some time to essentially adjust the prices up. And then I use 3 simulated scenarios. The first 2 are just differences in how spiky those prices get, whether they cover their capital costs in just an hour or 2 per year or a dozen or 2 hours per year. But the prices still spike. Just to give you an idea, this price spike in the fairly spiky case is about $1,000 per kilowatt hour per megawatt hour, and the very spiky is about $6,000 per megawatt hour for those of you who follow markets. $1,000 is about the price cap in many markets. $6,000 is above the price cap everywhere in the U.S., I believe, and it's a pretty high spike. Then the third set of simulated prices actually assumes what's going on in many markets these days, which is prices aren't allowed to get very high because prices are actually set at the marginal cost of the running units, and then the capacity costs are collected through some separate payment, which is just spread uniformly over all megawatt hours. And that, of course, has much less spiking in it, and in fact is pretty disadvantageous to solar PV. And that is something that, when it's used that way, undermines the cost or the value of the production. I'm going to go through this fairly quickly. I calculate the line losses that result as a result of the flow on the line and take into account that the line losses, the proportional line losses actually increase with the flow on the line. I then back out from the average losses this constant that determines the increase in the line losses between off-peak and peak times. What comes out of that is line losses that vary from 4.3% to 12% between the lowest and highest, and that actually lines up pretty well with data from the utilities. I think that's about all I'm going to say there. So that gets us to the actual valuation. And what I do here then is calculate, as I said, the average price or the average value of the power that's being produced by looking at the price in the market at the time the power is being produced. All that is a weighted average price in the market where the weights are the production of the solar PV panels. And that's essentially how the calculation is done. And I'm going to skip forward to the table, which might be too small to read, but I'll just tell you what it says. The left-hand column is the value if you didn't account for this. If you just said, let's value all solar PV power at the average price of electricity in the market. So that, in a sense, is the benchmark that is often pointed to as undervaluing solar PV. The other columns, let's focus on the south-facing panels for a moment, recalculate that, taking into account this time variation. All of these numbers, by the way, take into account the line losses, but the left-hand column just takes the average line losses, and as we move to in the other parts, it actually takes the time-varying line losses. The result is that we find that it increases the value of solar PV to take into account this time variation, but it really matters how the system is run. If the system is allowed to have very spiky prices, that can increase the value by 30% relative to valuing it at flat rates. And it varies by location. It's not quite as big a kick in Los Angeles as it is in San Francisco. These are the two cases where there's very spiky prices. If you actually look at the actual prices that were here at the time, there actually isn't much of an augmentation at all. That's because during this period, prices really weren't allowed to spike very much. In the early part because of price caps and controls. In the later period because there was just too much capacity in the market and you didn't see very spiky prices. The bottom row of each of these sections looks at what would happen if you kept the prices at the marginal cost of production but financed the capacity in the market by having a capacity payment. This is how markets are actually run these days. They don't allow prices to be particularly spiky most of the time, but they have a separate capacity payment. And what you find is that really undermines this boost to solar PV because you just don't have nearly as much capacity, nearly as much spiking in the prices. And so the fact that solar PV is producing more at peak times really just does not boost its value nearly as much. That's sort of an extreme case the way I've modeled it because I never let the price go above the marginal cost of the highest generator. And the highest generator is not that expensive in this simulation. So you got to think of the actual effect as somewhere between that and probably the line above it. But the bottom line is we see a significant boost. The boost is substantially larger if what we are doing is running the system in a way where prices are allowed to spike a lot. If you instead run the system with a lot of excess reserves and the price is not allowed to spike very much, and then you recover the cost of those excess reserves through some separate per kilowatt hour charge that doesn't spike at the high price times of the day, then you're really not going to get as much of a boost to solar PV. You can take these data and you can translate them to the value of production per year based on the average value per megawatt hour and the total production of the panels. And that's what I do here. So what I've done here is I've taken the panels, I've taken the numbers that were in the last table, multiplied them by the average production, and come up with the annual average value of the power that is produced. And this is the end-use delivered value. So this is taken into account the line losses of trying to deliver power from central station generation. And these are the numbers you get for a 3 kilowatt system. Okay? If you look at them and you just think about that fact, and if you know how much a 3 kilowatt system, or sorry, for a 10 kilowatt system, and you know how much a 10 kilowatt system costs, this is where things should start to get a little disconcerting. Installing a 10 kilowatt system costs about $80,000. The yield you're getting from it is something that's worth about $1,000 or a bit less or more, but around $1,000 per year. Right off the bat, that starts to tell you the economics of this are not looking very good. And this is accounted for line losses, and this is accounted for the peaking of solar PV. That is the fact that it produces more at peak times. So the one other area, before I get into talking about sort of the cost-benefit analysis, the one other area that people often point out is that if you put solar PV in a transmission-constrained area, you can avoid upgrading transmission as soon as you would otherwise need to, and that has value to it. And that's right. I mean, it's transparently right that if you put it where you really need the production, it's worth more than if you put it somewhere where the relative price is lower. So if you were to focus solar PV in a load pocket, an area where there's a lot of demand and it's hard to get power in, that would increase the value. Well, here's where the solar PV is in California. It's not particularly focused anywhere, it turns out. In fact, it's basically where the population is. there's been no, and this isn't surprising, California has a policy to promote the installation of solar PV, and the policy says nothing about location. You get the exact same rebate if you install it in an area where there is plenty of power as well if you install it in San Francisco, a transmission-constrained load pocket. And in fact, you can do this analysis by taking this is actually a data set of actual installations of solar PV in the state of California, and you can merge it with these prices. What these are is the state of California in 2004, in thinking about whether they should go to a more refined small zonal pricing system, created as if zonal prices for a bunch of different zones in the state. And essentially these zones are created to mimic the transmission areas, so that within each of these zones, at least the idea is, you don't really get much transmission constraints. The constraints, if they exist, are between zones. And so this is a way of looking at where would the power be most valuable. And if you sort of line this up, I'll just save you some work. SDG&E territory, this area, is the only area that has a really big premium on it. That's the area that has an annual value of $100.36. Okay? These are the value per kilowatt of capacity in different parts of the state. So this is actually taking the production profiles, merging them with the real-time prices to come up with what would the value of a kilowatt of solar be here, 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 et cetera. And it turns out it is more valuable in a load-constrained area, which SDG&E is. But it's not hugely more valuable. If you took all the solar PV in the state and put it in SDG&E, the lowest left-hand corner of the state, you would increase the value of the power by something like 15%, which would not be a trivial change, but it also wouldn't just sort of massively change the economics of solar PV either. Unfortunately, we haven't taken all of the power and put it there. We have taken a lot of power and put it there, it turns out, but the second column here lists the amount of capacity that's been installed in each of these zones, in each of these solar PV zones, or in each of these ISO zones. And it turns out there's no particular correlation between the two. In fact, if you take the solar PV production and you value it at statewide prices, and then you recalculate the value of the solar PV production at locational prices, you increase its value by about 1% in California. That's not particularly surprising since we don't have any policy of putting it in the high-value areas. Turns out we haven't put it in the high-value areas. And so this idea that you're reducing transmission constraints because you're putting it in the particularly constrained areas isn't really supported in the practice of the installation. So that was the analysis, the sort of the economic analytical part of the paper, to sort of go back and take these claims and try to put numbers on them. And so that when we think about the costs and benefits of installing solar PV, we don't have to sort of wave our hands at, well, how much boost is it really worth that it produces more? We actually have an idea of how big those numbers are. Likewise, at the transmission constraints. What I do next is take those numbers and from them and some other data on the cost of PV, create a cost-benefit analysis of installing solar PV. As I said earlier, solar PV, doing a cost-benefit analysis of solar PV is going to be very important to understand this concept of discounting, that money earned later is worth less than money earned today, because all of the costs of solar PV are up front. That's not quite true, but the vast majority of costs of solar PV are up front, and the benefits are later. So it's going to be very important to time weight the costs and benefits. Now, if you think the real cost of power is going to skyrocket later, then it could actually be that producing power 20 years from now is worth more. And I'm going to show you a case that looks like that. I think that's probably unlikely, and I'll tell you why. But in any case, it is important to not just do what is generally done in the industry, which is to take the upfront cost of the power, divide it by the total kilowatt hours produced over the lifetime of the panels, and call that the cost per kilowatt hour, which, by the way, gets you a nice low number. You got to account for a bunch of costs, the system cost, the inverter costs, and then, as I said, incorporate these numbers on the value of production. So this is what I do, and let me actually, yeah, I'll use this first. So let me just go through this line by line. So the first thing we need to do is just take inflation out of the picture. We're going to take CPI-like inflation completely out of the picture. We're just going to say we're doing this in inflation-adjusted terms. We're then going to look at the different possibilities for energy price inflation relative to other costs. But so all of these numbers, these interest rates and inflation and changes in energy prices are going to be real changes, that in the economic sense, that is adjusted for inflation. So then the question is, well, what discount rate should you use? Well, at this point we're doing a market valuation, and you have to ask, well, what discount rate would the market use? That is, what real discount rate, that interest rate above inflation. Probably the best number I would guess for a sort of market-wide analysis of these, the cost of capital is probably somewhere in the 3 to 5% above inflation range. So those two middle columns are probably the more reasonable ones. I'm going to use the 3% one just as a benchmark, but you can sort of make your own choices. You have to say something about the lifetime of the panels. I assume they last 25 years. That might be a little on the short end. On the other hand, I'm also going to assume that the maintenance and repair is 0. So neither of those is going to make much difference, it turns out. If you made that 30 years, it would increase the value a bit. On the other hand, if you start taking into account some of the problems you might run into, that would decrease the value. I account for inverter replacement, which occurs in years 8 and 16 in this analysis. Those numbers come from the National Renewable Energy Lab. And you get a total discounted present cost of system and inverters. By the way, the $80,000 for a 10 kilowatt system is a scalable number. I do this for 10 kilowatt because 10 is a nice number to do division by. You can do this for a 3 kilowatt system. There's nothing special about 10. Everything would just scale down, except you probably wouldn't want to scale down the numbers by a full 3/10 because, in fact, there's some economies of scale in installing solar PV. But that $80,000 is a pretty accurate number for what it actually costs. And we know this because in order to get your rebate when you install solar PV, you have to fill out a bunch of forms. And one of them is what was the cost of installing the solar PV. So we have a big data set on the actual installation costs. And that's, if anything, a little bit optimistic, but it's probably about right. So then we can say, well, what's the benefit of it? Well, the benefit is going to depend very much on what happens to electricity prices. The cost of producing, the real price of electricity. And I make a bunch of different assumptions, that it will actually fall in real terms, that it will remain constant in real terms, and that it will rise at various rates in real terms. That is, this will be 5% faster than inflation. This is a completely implausible number over the period we're talking about. If you actually had this inflation rate over 25 years, the real price of electricity would so vastly exceed the price of all sorts of other renewable energy sources well before you got to 25 years that it's just sort of not a plausible number. 1%, I would say, is probably the right benchmark. 3%, if you're really pushing it, I would probably argue that's a little implausible. Electricity prices are probably not going to fall in real terms. So we're probably somewhere in the middle here, but I sort of, again, gave it a range. These numbers are a little difficult to sort of process. These numbers are easier. What I've done here is I've calculated the levelized cost over the lifetime of the panels. So essentially what this says is if you priced every single kilowatt hour or megawatt hour at a given price and paid for it at the time it was produced at that price and then discounted it back, here's what you would get back to the full cost of the full discounted cost. So the levelized cost of using a 3% interest rate of a megawatt hour of production from solar PV is about $408 or 40 cents per kilowatt hour. That's sort of the translation you want to do. Comparing that to the value, well, if you run a sort of system with a lot of excess reserves, so there isn't much peaking, and so you don't get that super high value of solar PV, then the value I would probably focus on somewhere in here is $88 to $110 per megawatt hour, or 8 to 11 cents per kilowatt hour. Okay? If you ran a tighter system so that you try very hard not to use reserves to meet peaks, you instead let the price really spike and get some demand response, that pushes the price up substantially, and in the process you don't pay capacity payments. Generators actually collect their revenue from the power market. You get a higher value. But you're still pretty far away from $408. In fact, there are a lot of adjustments one can make, and I'm going to talk about a few of them in just a minute. None of them is really going to get us into this range. The gap on a market valuation level is quite substantial, and the various changes one could make really are sort of in the noise, it turns out. Okay, so let's talk about what the implications of this are for a moment. The gap that we see here, I'm going to sort of roughly characterize as $300. That's the 408 compared to 108 or so is probably sort of in the rough ballpark. That is that the cost is about $300 higher than the value of the power from solar PV. Well, I haven't accounted for any externalities here. Well, let's do the quick calculation on greenhouse gas externalities. A coal-fired power plant produces about 1 ton of CO2 per megawatt of electricity. So in order to make solar cost equivalent with a coal-fired power plant, greenhouse gases would have to sell for $300 per ton. That's not going to happen. To give you a couple of points of comparison, the bills currently being considered for tradable permit markets generally have escape valves in them. It says that if the price of the permits gets too high, the government will stand ready to sell an unlimited number of permits at some preset price. The negotiations that are going on right now are about whether that preset price will be $15 or $20, which I think is, really way too low. But that's the reality of what they're considering. To give you another benchmark, at $100 per ton of CO2, a whole bunch of renewable energy sources are highly economic. Wind power becomes economic well before that. And I don't want to get in a long discussion of intermittency of wind power and so forth. Wind power isn't going to by itself solve all problems. But there's a fair amount of it out there, and it is a whole lot cheaper and becomes economic at a much, much lower cost. But even if you look hard at the numbers for central station solar thermal power, a hard look still has the numbers below 20 cents a kilowatt hour and gets them into the money at $100 per ton of CO2. So this idea that it will get into the solar PV becomes economic because of the environmental benefits on the greenhouse gas side really doesn't add up. People make this network security argument that disaggregated production, it makes the system less vulnerable to network attacks. I don't even attempt to put a number on that. I think that's something that needs more study. Maybe that is a reason to do it, but certainly the case is far from having been made. Resource intermittency. This is probably actually less of an issue with solar PV on site than with most other, certainly than with wind power or with even solar PV farm, that if you build a giant solar PV installation. The argument that certainly makes sense to me, and I think generally most people in the industry have accepted, is that if you have solar PV on rooftops spread across the state, it doesn't get shady everywhere at the same time. It gets shady slowly in different places and sunny. And so this idea that you're going to you're going to cause grid instability with solar PV probably is not a very serious concern. Now, it's still an intermittent resource, just to be clear. It still comes and goes, but it doesn't probably come and go in a way that really makes the grid unstable. It means that you just have to value it when it's there. And that's what the earlier part of this analysis has done. This next bullet is actually the big point of contention, I think, when you talk to serious people about solar PV. There's plenty of folks out there who will just sort of do bad calculations of how much it costs or what the benefits are. But when you sort of start talking to serious people who are studying solar PV, they make the argument, well, there's learning by doing. We have to support solar PV now because it will get cheaper because we supported it now. And that's the critical link. It has to be causal. The fact that it's getting cheaper is not a reason to support it now. The argument is that by supporting it now, we will actually make it get cheaper more quickly. Unfortunately, not only is there no real solid evidence to support that, there's a pretty good reason to think it's not the case. First of all, the majority of the costs of solar PV installation have nothing to do with California installation of solar PV. The panels are made elsewhere. They're part of a worldwide market for panels. The inverters are made elsewhere. They're part of a worldwide market for inverters. One of CalSIA, the California Solar Energy Industry Association's own studies, said, look, you're just not going to lower those costs by installing a lot. And in fact, the California program, which is throwing $300 million a year at installing solar PV, has almost certainly raised the cost. Not surprisingly in the economic sense, which is if you throw a lot of money, if you push a lot of demand into a market, prices go up. We learned that in sort of Econ 1. But the argument is, well, if you install a lot of these, the folks who install them will get better at it. And that's true. The question is how big an effect that is and whether that's something that really calls for public policy intervention. And I want to just make 2 points on this. There are lots of things firms get better at when they do more of it, and we don't have public policies to support it. And the reason is we think firms are pretty good at appropriating those benefits. That is, if a firm gets large, if their scale economies, getting big lowers your costs. But we don't have subsidies to get firms big. And the reason is, if you lower your cost, that gives you a cost advantage. That is, you can privatize that advantage. The question is, are there cases where you can't appropriate those benefits? And the one that always stands out is intellectual property. The idea that you will develop knowledge and somebody else will steal it. And that is a non-trivial concern with learning by doing. If you get better at doing something and one of your employees decides to leave and start their own company, they essentially can take some of that knowledge. And that might be an argument for underinvestment because learning by doing occurs, but you don't have the right incentives because as soon as you learn, somebody else steals your knowledge. And that's why we have a patent system on the invention side. We don't really have that protection for learning by doing. So learning by doing may have appropriability problems. The problem is it's just going to be a small part of the cost. The best study that's been done on this is one by Greg Nemeth, who is a graduate student here now, a professor at the University of Wisconsin, who actually parsed the installation costs of solar PV, said how much does the panels cost, how much does the inverters cost, and said where could the learning by doing be happening from a statewide program. And that means it has to be on the state level, it has to be at the installation level, and realistically it's going to amount to a few percent. By the way, we've now installed over 30,000 solar PV installations in California, and you have to wonder where we are on that learning curve, even for those costs. Are we on the steep part, or are we sort of on the flattening out part? And I don't know the answer. But it's really a pretty, I think, a pretty unsupported argument. The flip side of that argument is the one that you often get from solar PV advocates, which is a graph. In fact, when I asked for information about learning by doing, I got 2 different studies that just showed a graph that said 1960, 1970, 1980. I should put, look, it got cheaper. Well, yeah, it did get cheaper. It's not clear that has anything to do with California subsidies. In fact, one could invert the graph and say, look how much it was getting cheaper when California had no subsidy program, and now that we have a subsidy program, it has stopped getting cheaper. I wouldn't infer that causality either. But it is certainly the case that that is not a proof that California should be installed, that California policy will lower costs. But interestingly, it is an argument in the opposite direction. It is an argument that technology is getting better, and it's getting better fast. And if that's the case, and if it's happening exogenously, that's an argument for actually waiting. Doing other stuff that's cost effective now and waiting for solar PV to get more cost effective. In economics terms, you're losing the option value to do this later if you install it today. And I think that's a pretty strong argument. In fact, the very people who have hated this study, many of them have told me that I'm an idiot because thin film solar only costs $5 a watt instead of $8 a watt, which may or may not be true, but in any case, it's not what's in the database and getting installed in California today. What the money is actually being spent on is silicon crystalline solar, and that's $8 a watt or higher. But if they're right, that's an argument for not doing this. That's an argument for waiting and doing the stuff that when it becomes economic. Let me talk about a few revisions that may sort of head off a couple issues. By the way, this paper is available online at the UCEI website, which is www.ucei.org, and it's working paper 176. The fuel costs and capacity costs I used, it turned out, were from 2004, and because of the massive run-up in steel prices, are a bit out of date. I'm in the process of revising them. That's going to raise the value of solar PV. If you thought of it as 108, you will now think of it as 128. It's not going to make a huge difference. Transmission infrastructure costs are not in there. And one could sort of say, well, if you could really eliminate transmission, you'd have a savings. That's true. That's a pretty extreme assumption since people aren't actually arguing they're going to get off the grid. But if you did, that would add probably $20 more, but not very much. There's some details about higher distribution losses than I actually said because it's focused on residential, which is probably right. That's going to have a very tiny effect. The D-rate factor I used to convert solar DC power to AC coming out of the plug was actually a bit generous. In fact, one of the things it didn't account for, it assumed these panels stay completely clean. And if you've actually dealt with this technology, one of the problems is they get dirty. In fact, there is a literature, an engineering literature on PV soiling that studies how dirty the panels get, how rain cleans them off, how snow blocks it, etc. And probably that will lower the value of the power. I'm in the process of incorporating local pollutants avoided. There are actually prices for those, and it probably, again, will make fairly little difference. Let me, and there are these costs of lifespan issues of lifespan I mentioned. Let me just quickly finish up by talking about a couple of confused criticisms. A lot of people have seen this paper and have said, wait a second. The value of power to me is 36 cents a kilowatt hour because that's what PG&E is charging me. That's true, by the way, if you're out on the 5th tier. You've got to be using a lot of electricity to get to 36 cents. But it is true that is your private avoidance cost. That's not what this paper calculates. This paper calculates a true market value. The reason PG&E is charging you 36 cents a kilowatt hour is not because power actually costs 36 cents a kilowatt hour to produce. It's because they got a lot of other money they have to generate, including covering the cost of the California electricity crisis, and a lot of it's coming from those people out on the 5th tier, the people who are paying the very high marginal price. This is a market valuation. I actually wrote a separate paper on the consumer level valuation. That's 172. And it even comes with a calculator, so you can go and calculate the private valuation to see if it's worth it to you. A number of people, including a consultant who has written a sort of Borenstein's an idiot paper, said, well, $408, that's nothing. A peaker plant costs $550 per megawatt hour, the most expensive peaker plant, and maybe that's right. There are some issues of how he actually did that. But even if it's right, that's exactly the problem. That's the anecdote coming back again. If you were always replacing a peaker plant, that would be the right comparison. The problem is you're not. There's plenty of solar power that is replacing base load. That is, it doesn't only produce on the hottest day of the year. It produces every day of the year. The lower cost of new technology I already mentioned. Yes, it is getting cheaper. The example that one critic has raised is that there's a new thin film installation in Germany that has been promised. It is actually not operating yet, but has been promised at $5 per megawatt or $5 per watt. It's a thin film technology. I hope it works. I am all for this technology. I hope it gets more cost effective. However, first of all, that isn't really a widely commercial technology. And secondly, it's a solar PV farm. It is not an end-use installation. So all those advantages of not having transmission and of not having line losses just went away. So if you do the calculation for that, you do have to adjust it. And then there's a long debate about, well, yeah, it's expensive, but fossil fuels are all subsidized. We're in the war in Iraq because in order to keep oil prices down. Well, sort of. So it hasn't worked very well, but nonetheless. And it's true, actually. There are huge subsidies for fossil fuel exploration in the United States. But they really are not driving the cost of generation in the U.S. Oil just has nothing to do with generation in the U.S. these days, period, except for in Massachusetts. Natural gas is at such a high price that importing LNG as a sort of long-run strategy is just clearly cheaper than the marginal cost of natural gas in the United States. So even if we are subsidizing exploration in the United States, that's just not the economic way. There's actually a more economic way than subsidized fossil fuels. Finally, if you're going to do that comparison, you then have to tell the story about wind power and central station solar thermal and biomass and geothermal and all the other technologies, because all of them, when you do the numbers, are half the solar PV numbers or less. And I think that the right read of this paper is not, well, we should just continue cranking out fossil fuel CO2, but we need to have a balanced analysis of what each of these alternative fuels really costs. And when we do that, we need to point the money for production where it's most cost effective. Aside from that, I think we also need to invest in research and development. The real failure, once we get the prices of fossil fuel, of CO2 right, which will adjust upward quite a bit the cost of fossil fuel generation, the other real failure is this intellectual property failure, is supporting research and development for alternative energy. That obviously has suffered a lot in the last 7 years. I'm hoping there will be more of that, not for my own personal support, since I do policy, not science, and what we really need is science breakthroughs, particularly in solar PV. Everybody I have talked to said this technology is just not going to get much cheaper than it is right now. The new technologies might, and that's not going to happen by putting this up on people's roofs. Thank you very much.
Time for some questions. Dr. Subramanian is going to pass the microphone around. There's one at the front here first.
Thanks, Severin. Does this work?
Yeah.
So I've been thinking about these issues for quite some time, and I don't really have any complaints with the analysis. I'm surprised that one of the sort of responses that you didn't mention wouldn't be, you know, if it seems what you're saying is if California decides to invest from a policy perspective in putting these panels on people's roofs in large scale, essentially we're taking one for the team. I mean, it is the way I see it, right? I mean, this is not, from an economic analysis, necessarily the most cost-effective use for our dollars. But have you gotten a response that says, well, look, you know, if Japan didn't do this, decide to pay a premium, more or less, for PV, and if Germany didn't do this, take one for the team, then Silicon Valley, which has a wide range of experience in silicon, the key material for PV, wouldn't be even thinking about it. There'd be one solar company in America called SunPower, a small company that's not making any money, and there might not be the opportunity for something in the long run. I mean, is that...
That's why I gave this talk, because this is actually a really intelligent comment, unlike the emails I've been getting for the last month. This is a good point. I don't agree with it, but I see your point. So the point is that if you really want to do this as a social analysis, you should also be including the benefits that Japan's going to get from us investing and the learning by doing. Now, we have to be clear on distinguishing again the learning by doing from the scale effects. There are scale effects, and the scale effects shouldn't be subsidized because the firms get to internalize those scale effects. I would argue that the evidence on the learning by doing in production here is still really weak, even at the worldwide level. But if you really did have that evidence, that there's worldwide learning by doing, that if we produce a whole more panels, the producing will actually make them cheaper, then I think that would be a much stronger argument. We could then say, look, we're doing lots of stuff to lead the world that's not cost effective. Doing anything about CO2 on a California basis isn't cost effective, so why don't we do this too? But then you still need to get back to the argument, well, should we be doing this instead of something that costs half as much? What about that stuff that costs half as much? That's getting cheaper too. And so I still think that you got a long ways to go with the argument, but I think that, yeah, it is a consideration that, you know, at some point we should be thinking about, well, our contribution to the rest of the world on in all of these areas.
Maybe an oversimplification, but is it fair to say that $2 a watt it all works, it all becomes viable?
$2, if you can do $2 an installed watt, yeah, I mean, it's a bit of an oversimplification, but yeah, you'd be roughly in the money. Actually, if you can get it down to $4 a watt, you're going to be pretty competitive with these other sources we've talked about. And you're going to be in the money at $100 per ton of CO2. That would be great. $4 a watt, end use installed, though. So this $5 a watt thin film farm still has its own set of problems. Yeah.
In some sense, you're confusing me because you've made this paper tiger of solar PV as economically viable, yet you already know the answer that only solar concentrators are economically viable. So I'm not sure why you didn't write the paper on solar concentrators. But the question for me to learn for the future is you say when you go to solar power farms, then how much of this do you lose? How much of your whole analysis then is a savings due to transmission rather than peak power?
Well, okay. First of all, on your first comment, everybody wants a different paper written. This was the paper that addressed the fact that California is spending $3 billion over 10 years on solar PV and essentially nothing or a much smaller number on central station solar thermal. Transmission losses. Well, the average transmission loss is 7%, transmission and distribution losses. You are avoiding that on average if you put the stuff on the house. And you got all that loss. The time-weighted transmission loss is a bit higher than that, though it turns out I think it's still less than 8%. That is, the fact that you're producing more solar at the peak times would, if you were at the other end, mean that you're losing more of it in the transmission. But that's the number, that's the range. No, it doesn't. So why did I do this analysis? I did this analysis because every time somebody pointed out this stuff costs $40 a kilowatt hour, 40 cents a kilowatt hour, somebody else said, yeah, but it's producing at peak times. It's not replacing a coal plant. It's replacing a super peaker generation plant. And it was all anecdotes. And so this was an attempt to actually say, okay, let's do this analysis right.
Hi, Professor. Thanks again for coming in and speaking to us. I was just curious if you were factoring any rebate incentives or tax credits in your calculation for PV. If not, why?
This is a market valuation. There are no rebates in here. There are no tax incentives. There's nothing that is just a transfer. This is actually an attempt to do the market value of it. Another paper I did does the consumer value. In there, there's rebates, there's tax incentives, there's the taxability of the interest rate, all of that stuff's in there. And that's the right thing to include if all you want to do is analyze the personal benefits. But if you want to do a societal-wide analysis, that stuff just doesn't belong in there, and that's why it's not.
So from my understanding, the way in which this pays back for people that are investing in it now is not just the state of California subsidies, but also the way in which PG&E or other utilities pay you for the hours of electricity produced. Is there an inherent subsidy in that, or is that a fair market payment?
No, it's not a fair market payment, but you got to be clear on what it is. What you're doing is you're avoiding paying for power coming over the line. And if in the hours when you are producing more than you are consuming, you are getting credited for that power. So you're getting credited against your bill, and all PG&E charges you for is the net. If you are a very small consumer, like most people in Berkeley, you're not very high up on the 5-tier pricing system that PG&E has. Your marginal rate, what you're replacing, could be as low as 10 or 11 cents a kilowatt hour. If you're up at 36 cents, actually now 35 cents a kilowatt hour, that's the highest tier. I have another paper on that. Then you're replacing very expensive power, but you're not actually, that's not saving society that much. You're just not paying for that power, and PG&E is not making money on that. And eventually PG&E raises that revenue in some other way, and the way it just basically rebalances the retail revenue. But that's, again, a retail analysis of a sort of individual savings. That's not what this paper does. The other paper does do that.
Real quick, have you looked at firms in respect to profits? Do you think there's like a producer surplus such that with the subsidies, I have people who are working for solar installation firms, and they see high margins, a lot of money coming in, way more than the marginal cost. Have you thought about that?
So no, solar PV installers are making money right now. There's some real scarcity rents being earned by the fact that there's a lot of money being channeled to solar PV. Is $8,000 the true long-run cost? In some sense, that it's not, but it probably is the true marginal cost right now, because what it's done is it's attracted a whole lot of small producers into the market who are not making that much money. And most of the guys who you're talking to, I bet, who are getting into this market are not getting into sort of the standard crystalline silicon installation market. They're getting into some new technology. And they think they're going to make more money. There are sort of, you're right in the sense that there are some inframarginal rents being earned. But on the margin, there are guys who actually are not making that much money at this. And actually, they're quite worried because the rebates are declining.
A quick comment from the technologist point of view. Thin film is, in round numbers, maybe a factor of 2 cheaper.
Great.
And the efficiencies which are currently achieved in manufacturing are on the order of, again, very round numbers, a factor of 2 less than what's been achieved in the laboratory. So in principle, you could have a factor of 4, which would be nice. It just seems to me we've got the cart in front of the horse. We should do the research first and the installations later. I
Hey,
wondered if you agree with that.
No, I obviously agree with it, but what's important is that a lot of the response, you know, there are the people who just say, I don't know how to do arithmetic, but the more sophisticated response is, well, this isn't the right calculation. You should be calculating for thin film. And then they all point to this one PV farm in Germany, which isn't online yet, but is almost done, and is supposed to be finished at $5 a watt. I hope it's true. You know, I would love to write a paper that says, look, this stuff's in the money now.
Yeah. If I understand correctly, the costs of PV, about half of the cost of residential installation is in the solar cells. So if we came down to about $4 a watt, wouldn't that essentially mean that we were getting free PV cells? And if we got free PV cells, wouldn't it make more sense to do it in a central installation?
I think there are lots of ways it could get a lot cheaper. Yes, part of it is the cells. Part of it is the installation could get cheaper. The balance of system isn't all labor, though. It includes inverters, which are also getting cheaper. So lots of stuff is. Yes, but your point is, obviously, if the cells were that, if you got down that way by having very cheap cells, you still have the installation cost problem.
So we're actually running out of time. I'm going to have one last question, and then we'll go from, people can talk to him afterwards.
I was just wondering if you could comment a bit more on the plant in Germany, because you make it sound as though it's an outlier. But if you look at applied materials, you can buy at $1.60 per watt capital expenditure, you know, as large of a plant as you want, effectively. That I think they guarantee 8%, or by 2010 at least will guarantee 8% efficiency. And from some NREL numbers that I've seen at a gigawatt per scale manufacturing, that brings it down to about 65 cents per watt. At 20% profit margin, that's 80 cents a watt or something. Those are not my numbers. Those are NREL's numbers. I don't know if you.
I don't. I hope you're right. I think it's great if it gets cheaper. What's actually getting installed on people's roofs right now is crystalline silicon at $8 plus per watt. You know, I hear these claims all the time. I hope they come true. But as I said to the guy who wrote me about the Germany plant, that's great news, but it's not news that has made it to California. He, by the way, then told me California is a backwater and you don't know what you're talking about. But no, I'm in no way saying we shouldn't pursue new technologies. That's, in fact, what I am saying. What we shouldn't be doing is spending money pursuing old technologies that aren't cost effective, and we should recognize what the true costs are of these technologies.
Okay, well, if you have any other questions, we can talk to him after this. Just wanted to give him one final round of applause, and thank you for speaking.
Thanks for that.